we do deals, right? And so like there is an enormous amount of pressure internally, externally to do deals, right? And so you have to constantly check that impulse, right? And as a syndicator, you get paid to do deals. Like you get paid a lot of money to do deals, and you put up a lot of money to get deals done, right? So the many pressures to like make you do a deal are huge.
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.
Arie Van Gemeren is a former Wall Street and venture capital executive turned real estate investor and entrepreneur. Arie, welcome to the show.
Thank you for having me, Sam. Good to be here.
Absolutely, my pleasure. Thanks for coming on today. There are 3 questions, Arie, I ask every guest who comes on the show in 90 seconds or less. Can you tell me, where did you start, where are you now, and how did you get there?
I started in traditional high finance, was a stock market research analyst, went to a major Wall Street bank, worked for a private family office in venture capital. And during that whole time was investing in properties on my own behalf with my own money and was doing well. I like to think I was a good investor, and the market helped me at the same time. Started investing in the mid 2010s. And then at some point I realized I knew a lot of the individuals who were really interested in doing real estate, but were really good at what they did. And there was a really big opportunity to take what I was doing, kind of upsize it. So we started doing syndicated deals. I started my firm in 2020, the depths of the pandemic, right when everyone kind of went home and was trying to figure out what to do. And that's when I decided to pull the trigger and kind of go start my company. And we've been investing across the West Coast of the United States, really focused on the San Francisco Bay Area, Portland and Seattle, buying core kind of inner city and close to inner city value add multifamily deals. We're up to a little over 200 units now across our portfolio and continuing to expand and have a bunch of stuff in contract right now. And where are we going? We're trying to be one of the larger players on West Coast multifamily real estate and eventually expand out into Denver and Salt Lake City as well.
That is awesome. So you've been buying property from 2010 to 2020. And in 2020, you said, you know what? I'm going to do my own thing.
Yep. Well, I didn't start in 2010. I wish I started in 2010. I would be way better off now. I started I was in the mid, like in the 2015, 2016 range when I kind of started.
Not a bad time to get in. I mean,
not a bad time. No, yeah, not a bad time.
No,
for
not
sure.
A bad time, but you weren't getting the basement pricing, the bargain basement pricing that you would have in 2010. That's for sure. Either way, what was the compelling reason in 2020 for you to get into value add multifamily, especially in the West Coast?
Yeah. In venture capital, I was focused on, property technology investing and financial technology investing and also raising capital, right? And I had met a ton of really interesting and influential family offices across the West Coast and in Mexico as well. And the commonality across them was there was a lot of suspicion of the venture capital business. Like, what's the cash flow? How secure is my investment? Like, is this going to make me money? I struggle with this. And most of these families had sizable real estate holdings. And, in 2020, tech investing sort of hit a big lull and everybody was sort of waiting, right? And investors were not committing to venture capital. And I had seen in my own underwriting and my own deals that I felt like I could control the outcome a lot more with multifamily investment. So my thought process was, hey guys, like we've been talking about VC. I don't know if you knew this. I'm doing real estate and this is kind of what I've been seeing happen. And I really believe in it. I know you do too, because your family's been in real estate for 100 years or whatever the story is, right? And so why don't we do something together and kind of go in and kind of make this happen and do some deals together, right? And there was a lot more appetite and interest for that. And I think in an uncertain environment, the ability to kind of probability weight your outcome to be like, look, if I put conservative numbers in here, I assume rents drop and I have a higher cap rate on exit, a whole bunch of stuff, I can still kind of tell you what your return's going to be, right? Versus pitching VC was like, it's a great idea, right? They have no revenue and it might happen, right? And if it works, it's going to be awesome. You're going to make a ton of money, but like, it's really likely it's not going to work was a harder pitch, right? So that was kind of why we launched this thing, right? And there's been a ton of investor appetite and interest.
Yeah, that is almost two completely opposite ends of of a sale. Like you if you get lucky, we'll hit a home run and it'll be great. What do they call that? I'm going to probably not use the right word because it's not the space I'm in. They call it a unicorn or something like that, where like
Yeah.
takes off, and that's what sets you right for life. Whereas what you're buying now is, I mean, it's stable, it's predictable, it produces revenue, and it's like, okay, you just clip the coupon and off we keep going. It's just
Yep. Yep.
not that wild and crazy, but it sounds like one is a much easier sell. Tell me this. I mean, Portland, Seattle, Bay Area, not typically. I know obviously it's there. People invest. There's lots of people buying, value add multifamily in those areas. But by and large, the sentiment is fairly opposed, I would say.
Sure.
Buying West Coast cities just from landlord restrictions to tenant laws to all those things. You say that is a prime opportunity and those are great places to invest. Break that down for me.
Yeah, I'll start with a fundamental lesson I learned in my stock market kind of equity research days. The CEO of my firm is a very large money management firm on the West Coast. Would always say, don't let your politics decide your investing, right? Because have your politics, have your political views, whatever they may be. Don't let that control what you do from an investment perspective, because the two don't always go hand in hand. Like, you can really believe in something, but that doesn't mean that it should inform how you think about investing. So that was I had that framework, right? Where it was like, look, I don't agree with a lot of the West Coast politics in many of these very progressive cities, but it doesn't mean that there's not a great investment opportunity, right? And I felt like the word on the street and what I was hearing was a lot of like, oh, a lot of landlords in Portland and Seattle were like, this place is becoming a disaster, and I got to get out of here. I got to take my money out. I want to go to a red state. I want to go to Idaho. I want to go somewhere else where it's a much friendlier business environment. And there's no denying, right? It is a friendlier business environment. I'm not contesting that at all. My contention was this. Major, very progressive left-wing cities on the West Coast have an appeal that is hard to dispute, right? You look at the Bay Area, you got Stanford, you got Cal, Santa Clara, major university ecosystems, right? That are continuing to pump out graduates, very smart graduates, right? From all over the world. International families all would kill to send their children to Stanford and Cal Berkeley, right? And they do, and they send their kids there, and very bright children are graduating from these schools. That's a great crop of candidates for companies, right? And if you want to get the best graduates from Stanford, you got to continue to have a presence in the Bay Area for those internships to bring those kids in, right? And so I felt like there was a theme of everyone's leaving and the Bay Area is going into a secular decline, and red states are on the rise, and these cities are going to be great because business is great. And I'm not denying any of that. I'm just saying I thought that the backlash against the progressive stronghold was sort of overblown, right? So that was the first piece. The second piece is I actually take the contention that these cities with very protective tenant right laws are perversely good for investors, right? So, little known fact, the guy that wrote the code for San Francisco rent control was one of the largest multifamily owners in San Francisco. And I've heard it said that in conversation, he said, I love rent control. I love it because it puts a floor on all my assets. I'm never going below that floor ever, right? I'm only going up, and it provides a ton of stability for my buildings. And I love it. I wrote that code, and I like that code, and I don't want it to go away. And it gives me a competitive advantage. That was from a major investor, right? And the things I've observed in these markets is rent control, difficulty building, right? All these things, they actually increase supply or they decrease supply, right? So you never have enough supply in these cities. And my observation was, and I think this is happening, right? Many of the up and booming markets in the Southeast, right? In Florida and these different markets, in my opinion, are probably headed for an oversupply problem at some point, right? Because you have population growing, but there's also there's no limitation on supply. Developers can build and build and build. Arizona is a great example of that, right? Where it's Arizona was hopping, Phoenix, money was pouring into these cities, but it was very easy to build, right? By contrast, in Portland, as an example, the city passed a law that if you want to build a new building, 30+% of the housing in it needs to be affordable, right? So if you put wages and material costs, which we know have both gone up, right? Developers aren't building anymore. And you can actually see permits drop off a cliff when that happens, right? But Portland's still growing, right? Like Portland's growing at double the national growth rate. So is Seattle, right? So they're growing, but you don't have supply. So there's like a broken supply and demand function in these cities. And I think thirdly, we have 100 years of anecdotal evidence to tell us that Florida is a boom and bust market, right? I mean, it's been going on since like the early 1900s. And I would argue that a lot of these like cities like Manhattan, I would put in the same bucket, right? Manhattan, San Francisco, Seattle are much more of a smooth ride, right? Like you're not going to have the huge drop-offs. You're just going to have a slow, steady kind of ticking up. And I would argue that's pretty conservative for investors. So we took that thesis and we're like, look, right-leaning landlords are selling based on political decisions. Like, let's go in and buy those properties because they're not thinking about this from the bigger picture. They're just like, this place has become really unfriendly to me. I want to get out of here. It has become unfriendly, right? And I'm not disputing that, but it's like, but you can work around it and there's less buyers, right? So you're not competing with as many people. So there's a lot of reasons why, it's worth fighting through the complexity. I think the return is there personally.
I think that's a very compelling thesis, and I've always said that anytime you get governmental involvement in things, that especially when they start making just arbitrary rules, whatever it is, rent control, you name it, it creates a market distortion for the looking for it. So I love your very clear explanation as to why you're finding opportunity and value in those markets, obviously decreasing supply and stable and or increasing demand. I mean, that's great for the investor.
Right.
What are things, as you went through COVID, as we went through 2020, how did you guys navigate some of those very tenant-friendly landlord laws, maybe that would have kept tenants in your buildings that maybe weren't paying, things like that?
So we did very well during COVID. And I think partly it's because we were really careful with location, right? So one of our kind of core beliefs or tenets has been to only buy in already upstanding in great locations, right? So we've really focused on sort of white collar neighborhoods, right? Like places with a great nightlife, a lot of fun, that have a high caliber type employee or professional that's living there or wants to live there, right? You're 20 to 28-year-old software engineer, right? So like an example would be Capitol Hill in Seattle, right? Capitol Hill in Seattle, like you're within almost walking distance of Amazon's headquarters. It's got the highest concentration of happy hours, right? Highly paid and like pretty legitimate tenant profile. And because of that, we had very, very little COVID-related delinquency, very little. And I know by contrast, I've talked to guys that own very large portfolios of like, kind of workforce housing focused assets, and their delinquency was much higher, right? Like they were like 10 to 20% non-payment, right? And we were probably like 1 to 3% non-payment.
Wow.
And I just think it's location, right? Like, I mean, if you own housing that is attractive to young professionals, like they're the least likely to not pay, right? Because it's not good for them. So they're going to get their parents to help, or they're going to pay, or they have a great job. Software engineers were not really affected. So, we did that. I will say, people in the Bay Area have gotten in trouble with the tenant protection laws. We're like Oakland and Berkeley and San Francisco are some of the last cities that still have an eviction moratorium, for example. And there's actually this is now I'm going to contradict myself, right? But this is some of the danger of this is like the city council of Oakland would like to never release the eviction moratorium. Their preference would be to like never let it go. And my question is like, so someone could not pay rent and you can never get rid of that tenant. And it's like, yeah, so that's the stuff that's sort of scary where you're like, well, that's a good argument to not do it, right? Because there is a political angle here that's a real problem. But now, that being said, there's already lawsuits working through the court to say like, you're now impeding my right to my property, right? And I'm pretty sure you can't forever prohibit someone from evicting a non-paying tenant from their building. So they'll get around that. But I mean, for us, we didn't really have to navigate COVID non-payment.
Hey, tell me this, coming from a long history in venture capital, what are kind of some of the crossovers there? I know you went to, the people that you were working with and said, hey, I see opportunity here. Do you want to partner on this? But I guess, are there lessons that you learned in doing venture capital that you've then applied to what you're doing now in multifamily?
Yeah. I mean, I think There's a couple, right? So deal flow in venture capital is very important, right? So there's a lot of money in venture capital, and there's a lot of money because there's a lot of high returns, right? But the little known fact in VC is like being in the right deals is where the high return comes from.
Right.
And you have to get into those deals. So there's always entrepreneurs raising money. That doesn't mean it's a good investment, right? There's always someone asking for money. And so you have two things happening, right? Your investors, your LPs are paying you a healthy salary and everything else to find deals.
Right.
And you have a natural like desire to put money to work because you've been given money to put to work. Right. So you have to find deals, right? And so deal flow is one of the highest and most important things, but it's got to be a good deal, right? Very much like our business, right? Like we need to find deals, but it can't be a bad deal, right? So the process of finding deals in VC was very analogous to finding deals here, right? It's relationship building, it's adding value for people, it's being in touch with guys, it's demonstrating, good characteristics that people want to do business with you and they want to work with you. I mean, in VC, your reputation is very, very important, right? Because entrepreneurs want investors that are thinking of them and are helping and providing value for them. And so, as we know, brokers also want to work with buyers that close deals and execute, do what they say they're going to do, and they're honorable and they say they live by their word, right? And so there was a lot of analog between those two. Doing good deals also really, really important, right? And so one of the tips I kind of learned from the VC business is to try to write an investment memo to myself, right? Because I'm really a firm of one right now, but when I have employees, I'm going to enforce that same thing. And we had to do that in VC because we had to get our deal through a committee. So you had to write a long form memo, risks, opportunities, what could go wrong, why I like the team, a whole bunch of stuff, right? And I found that the clarity of writing a memo down is really valuable. Like if you're writing a memo on a deal and you find yourself on every question trying to convince yourself like why you got to do this deal, but you feel like you're fighting resistance, it's a great warning sign, right? And I do think that the discipline of like putting it on paper, right? It could be a 2-page memo, but it should be like a formulaic memo, like why I like this deal, what am I missing? Why would I argue against this deal? Like you should play devil's advocate with yourself. And if you get through that process and at the end you're like, yeah, I got to do this deal. I just think it protects you, right? I mean, like Buffett has that famous quote of like, you should think of investing as a punch card and you only have 10, right? And you should think of like, if I do a deal, I only have 9 left in my life. That should be how you think about doing a deal, right? And if your deal is one of those 10, like great, but put it on paper, right? Like do that. That was a big, that was a cool thing I took from VC. And I haven't seen a lot of guys in the syndication business doing that. I know that at the bigger private equity real estate shops, it's very common, right? It's a Wall Street practice, it's a VC practice. But for younger guys, smaller guys that are starting up, I do think it's a good practice to build.
Oh, I think that's an amazing practice, and I love that. I kind of feel like I do that when I'm reviewing a deal deck, right? When we're putting together a deal deck, things like that. It's kind of that same process, but maybe not as not truncated, but maybe not as concise. There we go. That's the word I'm looking for. But I like that tip of going through that practice because I'm certain you've uncovered along the way a few deals maybe that you shouldn't have done.
Yeah. Yeah, I mean, yeah. And there's always the danger of being a deal guy or gal, right? Is that like we do deals, right? And so like there is an enormous amount of pressure internally, externally to do deals, right? And so you have to constantly check that impulse, right? And as a syndicator, you get paid to do deals. Like you get paid a lot of money to do deals and you put up a lot of money to get deals done, right? So the many pressures to like make you do a deal are huge. And you gotta find a way to get out of that for a second, right? And get out of that cook pot and be like, but should I do this deal, right? Because there's the broker's pressuring you to do it. The broker only gets paid if the deal gets done. Your attorney wants the deal to get done. Your investors want to get it done. Your wife or husband probably wants you to get it done because you're gonna get paid. But you're like, and you got to check that, right? It's really hard. It's hard, right? I mean, it's a hard thing to do.
It truly is, and I think the discipline to slow down and say no, because you're absolutely right. Like if you're not doing deals, if you're not consistently presenting opportunity to your investors, they go other places.
Totally. Yeah, exactly.
Reality of it. They're not waiting 9 months for you to come back with your next deal and be like, oh, cool, I'm still sitting on that $500,000 I was going to put in your deal. Like that on. So there is that constant pressure, like you said, from many sources to continue to put out deals. But I love the way that you think through that. Arie, it's been an absolute blast having you here on the show today. I certainly appreciate it. I've learned so much from you. The venture capital world is something I know absolutely nothing or very little about. So it's fun to get perspective from somebody that's been in it for such a long time, and then how and why you're finding opportunity there in the West Coast cities. I think you presented just an absolutely impressive case as to why you're investing there and why there's opportunity there, and then how you guys are working around some of the political and or market risks and finding opportunity there. So thanks again for breaking that down for us. Certainly appreciate it. If our listeners want to get in touch with you, learn more about you, what is the best way to do that?
You can go to my website, www.lombardequities.com. And it's probably the best way. And then my email is Arie@lombardequities.com. So if anyone wants to reach out or chat, I'm always happy to talk with anyone, especially about this business. I love it. And I could talk for hours about it. So yeah, it's been a pleasure to be here, Sam. Thanks for having me.
Thank you, sir. And for those of you who are listening, that's Arie, Arie at LombardEquities.com. We'll make sure we also put that there in the show notes. Thank you again, Arie. Have a great rest of your day.
Thank you.